Hello everyone, good morning. We're moving on this week to chapter 3. This is after test 1. Hopefully everybody feels good about test 1, which will be next week. This is moving ahead to chapter 3 when we talk about the main focus of chapter 3. What's discussed are adjusting entries. I thought because adjusting entries are something that nobody really loves, I would take a few minutes to explain each type. And I'm going to refer to pages in the book as well as slides if you happen to be looking at your PowerPoint slides, rather than, I know a lot of people don't have the book in front of them yet. Or maybe you do by the time you're watching this. But anyway, I'm going to talk about the pages in the book as well as the slides that you could be looking at. Just a little bit about adjusting entries. For one thing, they're very necessary to get the accounts to be up to date. Why do we need that? So we can make financial statements that are correct. In chapters 1 and 2, we made financial statements, but many of the accounts were not correct because they needed to be adjusted, and that's what we're going to do here. We're going to make new financial statements. Not yet, though. Okay, what are they? Okay, they're recorded at the end of each accounting period. You can do it for a month, a quarter, or a 12-month fiscal year period. We're doing it in this chapter for November and December Smart Touch Learning, so it's 2 months ended. If you look on page 120, you'll see figure 3-1. If you're looking at your slides, it's slide 3-16. And it says unadjusted trial balance for Smart Touch Learning. I know you can't really focus on that, but that's page 120 in the book, and it is slide 3-16. This is not coincidentally the same exact trial balance we saw at the end of chapter 2 on page 76, 2-10. But they didn't call it unadjusted, they just said trial balance. Because they didn't want you to think it wasn't right, but it wasn't right. Okay, so we need to record these adjustments before we can have correct balances of certain accounts. And we're going to talk about what those accounts are. So we have to record revenues in the period when they're earned. If you go back and maybe review chapter 1 where we talk about some of the principles and concepts of accounting, one of the biggies is the revenue recognition principle. And this dictates that we have to recognize revenue when it's earned in the period that we earned it. This is the reason for the adjustments. Revenue actually gets adjusted twice. It gets adjusted as a deferral. That's when we get money in advance of earning it, and then we earn it. And then it gets adjusted as an accrual, which is charges. We've been doing that all along. When people charge, we did the work and they charged the work, it's accounts receivable. So the revenue account, in this case it's going to be called service revenue because we're in the service business, is going to get 2 different adjustments. But we'll get to that. So that's the first goal. The second goal is to record expenses in the period when they were incurred. The word incurred is an accounting word. What it means is when they happened. Okay? There's a couple of accounting speak type words that I'll translate for you as we go along. Okay, so we're going to learn about 4 types in this. In this video, we're going to do the first 2, part 1. And then the second video, not to make them too long, we're going to do the 2 accruals. I don't say accruals very well, but I say accrued just perfectly. I don't know why that this is, but you'll notice how badly I say the word accrual. I just can't say it. I might get 1 time out of 100. I think I just got that 1 time just now. But accrued, no problem. I don't know what it is. But anyway, we have 2 types of deferrals. We have the deferred expenses, which is probably our longest. Most examples, I have 3 examples for this following the book. Deferred revenue, there's only 1. The word deferred means we're going to do it later. We're going to defer it to later, and the end of the period is the time that you defer it to. Okay? Again, the word accrual, means that it happened already, okay? And it happened in this period. You have to recognize it in this period both as expenses or revenue. Okay? One thing about adjusting entries, they're never going to involve cash. Ever, ever, ever. Because cash is what we call a self-adjusting account. When we get cash, we increase it. When we pay cash, we decrease it. No adjustment is necessary. Okay? So our adjusting entries will never involve cash. The other good thing about them is they're always done the same way. Only the numbers will change. Okay, I have to erase this now, unfortunately, to go on to my examples again. In this video, we're going to do the deferrals. This is going to be the short one. The first one is going to be a little longer. Okay, here I go with my mass swipe here. Okay. I was going to get more erases, but this seems to work better, so I'll go with them. Okay, so our deferrals. First deferral is deferred expenses. I'm already spelling deferred wrong, sorry. Okay, a little bit about what they are. Okay, they're also called prepaid expenses, which means you've already paid for them. Also, the thing about deferrals, both as expenses or as revenue, money has already changed hands. With deferred or prepaid expenses, you've paid for something in advance of using it. Okay. So anything prepaid fits that classification. Problem is, when you prepay for things, eventually you use them up. Time goes by, you use them up. That's when we're going to do the adjustment. As we use it, we're going to see how much we used and expense it. All prepaid start out life as assets, and then as time goes on, they get expensed and the asset gets used up. Whenever you see used, that means an expense is going to come. Okay? Used and expense, same thing. They also love the word expired in the book. This much insurance expired. That means used up. Okay? So prepaid expenses, I should have an S there because there's more than one. We have, they're called prepaid. Some examples: prepaid rent, prepaid insurance. Some of their favorite ones are rent and insurance. What else can we prepay? Those are their two biggies. Another prepaid expense that doesn't start with the word prepaid is office supplies. They get used up, right? So far we just buy them and we never seem to use them in chapters 1 or 2. They never go away. That's very unrealistic. When we buy supplies, we use them. So now we're going to see them being used. The last one I'm going to talk about is depreciation. Okay, depreciation is kind of its own thing. I call it the made-up expense. This is depreciation on long-term, or called PP&E, property, plant, and equipment, like buildings and vehicles and computers and their favorite equipment. Okay, these are things we buy, but and they depreciate. In other words, they lose value as you use them. You heard of it with your vehicles, the depreciation, nobody likes it. But in business, it's kind of your friend because you get to expense it over the useful life of the asset. Depreciation is kind of its own thing because we never lower the asset until we sell it, get rid of it, or trade it in. We have a separate account for depreciation to hold it on the credit side. Depreciation expense will be the debit. The credit will be an account, it's called a contra asset. Contra means the opposite. It's right under the asset it goes with. You'll see building, depreciation, accumulated depreciation, building. And the balance will be on the credit side, holding that amount of depreciation because we can't ever credit the asset until it's physically gone. Okay? The others we do credit the asset. because it is physically gone, okay? So, let's take a look at our first example. Okay, and in slides now, I'm on 320. Let's see, let me get there. I always mess up my slides in class too. I'm going to do prepaid rent on page 121. Okay, so I think I have room. So that would be this one, this first one we're going to look at. So Smart Touch Learning, right? Whoops, I'm messing up my slides. They prepaid, I'm not going to write the whole thing out because that'll take too much time. But if you're looking at slide 3-20 or page 121, you'll see the example. Smart Touch prepaid 3 months of rent on office, on the office, rent on their office, and they paid $3,000. They did this December 1st. Okay, so this is what it would look like December 1st. We would have prepaid rent, and we would have debited that for $3,000 because our asset of prepaid is increasing, and then we would have credited cash. This is not the adjusting entry, this is the initial entry for the prepay of the rent. Huh? So, it's December 31st. That's not right anymore because time has gone by and we've used up, or like the book likes to say, 1/3 of it has expired. You'll notice that come up. It's kind of annoying, I think, but anyway. So we posted that like this, prepaid rent, okay, initially on 12/1 for $3,000. So we used some of it, right? It's the end of the month, 1/3. So we used 1/3 of $3,000, it's $1,000 a month. So we know our adjusting entry is, I know I'm doing the posting first, I'm kind of cheating. I'm supposed to journalize and then post. And the balance of prepaid at the end of December should be $2,000, not $3,000, like it says in the unadjusted trial balance, right? So we need an adjusting entry for our deferred expense, okay? So on 12/31, our adjusting entry would be rent expense for the amount that got used up, $1,000, and then credit prepaid because it has been kind of dwindling. Every month it's going to dwindle until the end of February where it's totally used up and you've got to prepay again. So our prepaid rent would be credited for $1,000. This is our adjusting entry, okay? And that's how you do the deferred, right? The deferred expense. I have actually another example that follows the book. And again, those slides go up to 3-22. Moving on to 3-23, the office supplies, okay, which is this one. Insurance would be done the same way. Okay. So is office supplies going to be done the same way, but let me get rid of this. Okay. So we've been buying office supplies since chapter 1, but not one of them seems to have gotten used up. So we know the office supplies balance, I think it's $500, is not correct. Okay. So, the page I'm on now would be, right here. This would be on slide 23 and 24, page 122. Nope, 120, yeah, bottom of 122, top of 123. So this is the office supplies. Why, you might say, why am I doing another example of a deferred expense? The reason I am, and the reason the book has the same one, is they present the supplies in a different way. They kind of put a little twist on it. Instead of telling you how much was used from the office supplies, about 95% of the time they just give you the balance of the account and you have to subtract and plug it in. I'll show you what I mean. It says on slide 323 and on the bottom end of 122 going into 123 that we purchased on November 3rd $500 worth of office supplies on account. A lot of people ask me about the supplies. Well, they bought it on account. They didn't pay for it in advance. They charged it. That doesn't matter, okay? With office supplies, whether you charged it or you paid for it, you still used it. So you have to put the expenses in the period they happened. I get that question every time. It's a very good question, but the answer is it doesn't matter if it was charged or paid for. In this case, it was charged. They actually paid I believe 400 of this $500 bill. So that was the initial entry on November the 3rd. Okay? But that's not the balance of office supplies right now. What it says is, in the second sentence, as of December 31st, $100 of the supplies remain on hand. Whenever you see those words on hand, it means balance of the account. That's what's left. Don't get tricked and use that $100 as the amount used. That is the balance of the account. How you can kind of be sure you're doing it right, make yourself a little T account and kind of make yourself, I love T accounts, they're ledger accounts, because it shows you a diagram of what's happening. It's a picture, and who doesn't like that, right? So on 11/3, if we posted this to the ledger, we would have a debit to office supplies and then a credit to accounts payable, which I'm not going to show you because we don't have to adjust accounts payable. That's supposed to be a P, by the way. It's a terrible P. Not much better, but okay. So what this is saying is we had $500 on 11/3. And as of 12/31, on hand means balance of the account is $100. Again, don't forget, on hand doesn't mean used, it means balance. So what we do need is fill in the blank. This is the only prepaid expense that is done this way for the most part. I can't think of another circumstance where you had to subtract. I'm pretty sure it doesn't exist in this chapter. It could be, if they gave you the balance, you could fill in the blank for anything. But with office supplies, almost all the time. So what's 5 minus 1? 4, right? So here's the used. And used, as always, equals expense. So now we know what our adjustment is going to be. The adjusting entry for office supplies used up on 12/31 is supplies expense, debit for $400, credit office supplies. To bring them down to the $100 they're supposed to be. 5 minus 4 equals 1. And again, almost all the time they present it this way. There's a few instances where they give you the amount used. Not that many. Okay? So the last example I'm going to show you is for depreciation, at least for our expenses. Depreciation starts on slide 3-25 to 3-31. And let me see, starts on 124 to 127, pretty much. It shows you the whole thing. I'm just going to show you one example of it. So let me try to make that stay there for a minute. Let me show you about depreciation. Depreciation is super easy. They always give you the amount depreciated, at least in Accounting 101. If you take 102, you have to figure it out yourself, but it's still pretty easy. I'm going to show you the formula that's shown in the book, just so you can see it. To figure depreciation, it's called straight line, and the reason it's called straight line is if you graph it on a bar graph, it makes a straight line because it's always the same. So you could connect the dots and you'll always have a straight line. So straight line depreciation equals cost, whatever you paid, minus what's called a residual value, which means this is statistically what the value would be after it's all depreciated. That's the numerator. The denominator is the useful life in years. You really won't have to figure out depreciation, but they do put in this one example. And this example is for, what's it for? Oh, by the way, I didn't tell you. One property, plant, and equipment long-term asset that does not depreciate, the only one is land. Never depreciate land. There's no accumulated account for land. Land actually appreciates rather than depreciates. It gains value rather than loses value. Oh good, we have gardening people outside. Okay. So, let me put it into the example they give. This is the furniture that Sheena contributed on December 2nd. If you look at slide 327 on page, page 124 at the top, you can see her initial contribution on December 2nd. We debited the furniture and credited the capital, because whenever the owner contributes something, money or another asset, they get capital for it, equivalent. Again, we're never going to credit the asset in a depreciation adjustment. We're going to credit that accumulated account. Each one will have its own. And they'll just tell you what it was. Depreciation for this period was $3,000, whatever it is. But in this case, they go by the formula. So they put it in the formula. So the cost, I'm going to do it, is $18,000 for the furniture. And 0 is the residual value because furniture doesn't have residual value. But if it did have one, it'd tell you, so you could minus it out. The useful life is 5 years. Does that even look like years? No. Not much better. So 18,000 divided by 5 years would be 3,600 a year. And if you put this on a bar graph, you would make a straight line. The dots would connect in a straight line. That's where it gets its name. One of the 3 methods of depreciation that is used and the most popular, because it's easy. The other 2 are not bad either. So, we're going to depreciate this furniture $3,600 per year, but we've only had it for a month. So what do we have to do? We have to break it down times 1/12. So we need it for a month, so 3,600 times 1/12 should be 300 per month. Because that's all we need to depreciate. We've only had it for 1 month. So here comes the journal entry, always the same, okay? When you have a depreciation problem, no surprise, you're going to debit depreciation expense for $100 for the month of December. You are not going to credit the furniture. Never credit the asset it goes with until the asset is gone physically. I'm stepping on paper. Okay, so here's the 100. Credit accumulated. I'm going to write it out the first time and then I'm going to call it A/D in the future. Kind of a long name. It's a contra asset. It increases on the credit side. It's in the asset section right under the asset it goes with. This accumulated account and all of them for each property, plant, and equipment asset holds the depreciation from period to period till it's fully depreciated. So that's the story of depreciation. I'm not going to put this on the board, but if you look at There's another one for the building that depreciated $250. If you go to 127, you'll see the balance sheet presentation. That shows the property, plant, and equipment. Again, it's 127 slide. I'll get it. Maybe just by me holding it up, you can refer to it more easily. This is on the top of 127, showing the land with no accumulated account because it doesn't depreciate. The building, $60,000 cost minus accumulated depreciation. We call what's left book value, just like with your car. Cost minus depreciation equals book value. Same with this. Furniture, the one that I did, okay, $18,000 was the cost. The furniture for 1 month only depreciated $300. The book value $17,700. Notice what we're adding up for the total long-term assets are the book values. Even though the cost still remains, and it will remain until the asset is sold, traded in, or otherwise gotten rid of to the junkyard maybe. Okay, that's the story for the expenses. The story for the revenue is much shorter. I can do it very quickly. There's only one way to have deferred revenue, and that's if you got money in advance of earning it. So, the only liability that doesn't end with the word payable is the unearned revenue. And it's a liability because you got paid and you didn't do the work, so you're obligated to do the work. So, deferred revenue example. Again, it starts on 334 slide. And it's right here. Yeah, okay. So this would be the second deferral, deferred revenue. And it only involves one situation, when we earn some of this money that we got paid in advance. So if we look at slide 335, we see that on December 31st, right, a law firm hired Smart Touch to provide e-learning services for the next 30 days, and they paid them $600 in advance. So we see at the bottom of page 127 that it shows the cash that they got on December 21st debited in unearned revenue, the liability, the only one that doesn't end with payable, is credited because they got the money, they didn't earn any of it yet. But if we move on to the next slide, I'm sorry this is kind of awkward, but I'm trying to look at three things at once. During the last 10 days of the month, if you switch the page over, 1/3 of the revenue will be earned. So we need to make an adjustment. Right? So for this deferred revenue, we have 1/3 of $600 that was earned in December, from the 21st to the 31st. That's $200, right? That's the amount of revenue earned. That has to be credited to the revenue account because it was earned in December. Okay. The other 400 will be a balance. Let me show you in the T account. Unearned, sorry my writing's getting so messy. I'm trying to rush a little bit. 600 was initially the liability when we got the money in advance on the 21st of December. We earned 200, 1/3 of 600 as of 12/31. The balance that we haven't earned yet and will be earning in January is $400. Okay? They're not asking for that, but they're going to show it. So what we want as a adjusting entry for our deferred or unearned revenue is to debit unearned revenue always because it's a liability. It increases on the credit side, so it decreases on the debit side. for 200, and then service revenue gets credited, as revenue always does, for 200. And that's what our adjusting entry is always going to look like when we earn some of that money that we were paid in advance. And that's it for my deferrals. And I'll see you back for the accruals in a couple minutes.